Right, this is one of two videos I'm going to quickly record. The first one is a rundown of the trading calculator Excel spreadsheet that you've got access to, how to use it, what you're going to get from it, why it's important. And then I'm going to hop onto the whiteboard and give you a bit more of a visual representation that might resonate with you in an easier way as well. So let's get straight to it. So first things first, when you open the spreadsheet, you've got the tool tab, probable losses, drawdown recovery, compound calculator, break-even win rate, and then the strategy log. So I'm going to touch on briefly how you use them all. You can't break it, have a play with it. So if I start with strategy log, this is where you would, using either our hard-coded settings or our own spreadsheet in Discord, drop your desired strategies in here just so you can see the numbers. The data from here doesn't have to be used or pulled through in the other tabs, but it's just handy to have all of your data all in one place if that's how you chose to do it. What you've got here in terms of break-even win rate is understanding risk to reward. So when we're trading mainly on our follow trend and stop loss strategy on the 1 hour, we're trading in a way that is riding the biggest trend we possibly can, which is fundamental to profitability and also enables us to have a high risk to reward. That means two things. It means we're going to be wrong a lot, but it also means that it's important to let that winner run on for as long as we possibly can. And it also means that we can be right, not very often, and have our edge in the market. And that can all be seen in the strategy tester and the backtesting data that you have at the, at the bottom of your fingertips within seconds. So if we had an average risk to reward of 1 to 5, a win rate of at least 16.7% is one that then puts us into profitability, is an example. And you can see on here that by looking at these different numbers, a 1 to 2 risk to reward, we can be 33.3% as a minimum winning, and that makes us profitable. So you can see how that all plays out. But I'm a big believer that you can't play around with them numbers. There's no point in a discretionary trader entering a trade with the intention of it being a 1 to 10 risk to reward and balking at or choking at the profit that's running and closing it at a 1 to 1. There's absolutely no point at all. And that's why it's really important then to get to a point where your risk, your lot sizes, how you're setting your stall out with your trading gets you to a point where you can detach from fear and excitement and all of those things and really let your strategy play out as it should. So the compound calculator is also one that you really need to get your head into. This is for one or two reasons. The main being that this is what's going to encourage you to stay disciplined on your longer term goal. So there's a quote, isn't there, that says, people overestimate what they can do in a short space of time, but underestimate what they can do in a long period of time. This is that, okay? So what most are trying to do is make far too much profit from their account in a short space of time, then understanding that if they just stay disciplined on their approach, was consistent and stuck at it over a long period of time, then those gains are going to be far bigger than probably what they realize due to compounding. So for example, let's start with £1,000 account. You can pop your number in on here. Let's say you're looking for an average monthly gain of 7%. And let's say you might be able to afford from your employment or whatever to top that up by £100 a month. Just because it encourages and accelerates this process. You don't have to do that. But if you did, you can see very quickly how this compound graph just updates itself and works. So starting with £1,000, after year 1, you'll be just at 3,683. And in 2 years, 10 grand. And dare I say, look at years 4 and 5. But that would mean that in your first month, you're looking to gain £70, right? Most people, they don't like that. Most people are like, oh, £70 shit. I could go and trade with so-and-so on Instagram who's made 50% in a month. All of them gains and all of that shit that you see everywhere is not sustainable. You're just going to end up blowing your 1,000 and starting again. And it'll get to a point where you then realise that this is the only way to do it in a sustainable way, and it depends how much and how many accounts that's cost you to learn that fact. Okay? So really play around with this, print it out, frame it, do whatever you want to do with it, but get sold on this longer term process and this longer term view. hopping from strategy to strategy, being inconsistent with how you trade, not getting your risk management nailed on, being emotional, revenge trading, chasing losses, all of that stuff is going to pull you further away from these longer term goals. So whenever you get that voice in your head, that little chimp that says, chase that loss, or yeah, that trade's a surefire winner, let's go really, really big on the lot size, then you have to think 3 or 4 steps ahead. Is this a behavior and an action that's going to get me closer to my goal, yes or no? Is it really a surefire winner, or is it the same probability of any trade that I've taken historically? Of course. What would happen if? And this what would happen if is such a very, very powerful thing that really should help you understand to think those 3 or 4 moves ahead. Well, what happens if I'm wrong? Well, I'm probably going to lose more than I really thought because I think I'm right. I'm not actually anticipating that trade's going to hit stop loss, for example. What happens if I win? Well, if it win, you've got this reward through a random outcome. And so many times we've all been in a situation where we've got lucky, made some profit on a trade that wasn't in our plan, we risked too much, and it worked out. All that does is trick your brain into thinking that that's something that you can keep doing because it worked before. And we all know where it ends. It's not sustainable. It will hurt you. It will cost you more than you think. So whenever these little voices come into your head, think 3 or 4 moves in advance. Well, it might win this time, but it probably won't win the time after that. If it loses this time, I'm putting myself further away from these longer term goals that I've got. Okay? Hopefully that makes sense. I'm digressing again. Drawdown recovery is something that I needed to show you this to touch on before I talk about it on the whiteboard. So what this means is, if you were to have £1,000 account and you go and lose half of it, people don't realise, but it's quite sobering to think that you then need to flip that account. You need a 100% gain on your £500 to get yourself back to break even. And you've got less cash to play with, so if you're still risking, which you should be, 1%, let's say for example, then that 1% is half the value that it was before. So it's going to take you double the amount of time to get you back to where you started. So ultimately, the key part is to make sure you are factoring in the probability of that losing run. Let's say on this dice analogy, you're going to see at one point 20 to 25 consecutive losses you just go into one day. You need to plan for that. And once you've planned for that, then you've got so much more detachment and emotional control over your trading, because after losing streak 10, I've planned for 20. I always knew 20 could happen. Then how do you feel? Far better, don't you? If you don't plan for it, you shit yourself after losing streak 5. But none of that should be a surprise, because if you've taken the time to understand, for example, the strategy tester on our strategy, if we've got a 20% win rate strategy, we should know, and you should know, that we're going to see losing runs, right? And if you're risking a fixed amount or a 1 or 2 or 3% per trade, you're going to run out of money very quickly. Let me just give you an example. So if you had a £1,000 account and you're risking 1% per trade on a 17-20% win rate strategy, after losing trade 20, your account balance is at £826. So you've nearly already lost 20% trading one strategy. Yeah, let alone however many others you might be trading. Now, our calculator will factor that into your losing run and to within your maximal drawdown, which will then tell you and suggest that really you should be trading around 0.3, for example. If you traded 0.3% and had the same 20 consecutive losing streak, then you would have £944 as opposed to 826. It's quite a big difference, but it's really important to understand that yes, your gains are going to be less. Of course they are. But that doesn't mean it's still not going to give you what you need in terms of your longer term profitability. Yeah? So, what we're looking for is to keep our account at no more risk than 20% of your initial balance, or 25. Because you can see here that you need then a 25 or a 33% gain to get you back to where you started. As soon as you get too far deep down this process, that's when it becomes a very uphill battle. Okay, so we're going to talk about that on the whiteboard shortly. Right, so here's a visual explanation and a visual diagram on the probability of losing runs. And it's fair to say as well that if I just took 10 tosses of this coin, I stand a chance of seeing a smaller losing run than if I was to toss 100. Yeah? So, again, trading's the same. So the more data and the busier a strategy, the more trades there are, the more likely it is that we're going to see a consecutive losing run because there's more possible outcomes. Yeah? So let's just take 100 trades, for example. Yeah? This is the losing rate, so the opposite of the win rate, obviously. So if we've got a win rate that's 90%, that means we've got a losing rate of 10%. What that means is it's really, really, really unlikely that you would see any more than a 4 trade. It's nearly impossible. Losing run. Yeah? But you could still see 2. Yeah? Let's flip that on its head a little bit more. Let's say we've got a win rate of 30%. So that means a losing streak of 70%. You can see here, look, the chances of 4, 5, 6, still in their 90s, yeah? But as we get to trade number 15, there's a 12% chance that we could see a losing streak of 15 consecutive losses, yeah? So although you'd say that's unlikely, it's still possible, yeah? We've got 2 things here. We've got possible and probable, right? So just because something is possible doesn't mean it's likely, it just means it can and probably will happen at some point, but not very frequently. There's also something that Mark Douglas talks about in his Trading in the Zone book, and that's the 2 levels of probability that we have. So those 2 levels are something called macro and micro levels. And what that means is, if I take the coin example, every single toss of this coin is unique in its own right. Just because I've spun 4 tails, on that 5th toss of the coin, that doesn't mean I'm likely to see another tails, and it doesn't mean I'm now likely to see a heads because I've seen 4 tails. It means there's a 50% chance still that I'm going to see either. This is why so many traders get overconfident after a winning run, and maybe the other way on a losing run. And it just doesn't work like that. Every trade is unique in its own right. However, the other level of the probability scale is that there's still a 50% chance, right? So if I've got 100 spins or tosses of this coin, there becomes a point where I'm likely to see a 50%, 50 heads, 50 tails-ish over a period of time. And this is where trading and what we do is very similar to that. Every trade is unique, but we have enough set of data that gives us our edge and our confidence in executing to our plan. But you've got to play it out. There's no point in spinning this 5 times, tossing this 5 times, getting 5 losers and thinking that it's shit and doesn't work. Well, you've got to keep going, yeah? But you've got to have enough money to keep going, and that's why managing your risk geared around win rate is taking things to the next level. And ultimately, because the more we look at our strategy and optimize, the more that win rate per strategy is different, yeah? And although obviously I've always said win rate does not affect profitability at all, and it doesn't. It absolutely doesn't. But what you have got to do is make sure you've got enough money left to play the game. One of the previous videos I did was if we risked £100 on every roll of the dice, for example, out of our £1,000 balance, I'm going to run out of money, yeah, because I'm going to hit a losing run of more than 9 or 10 at some point, and I'm going to bankroll myself. So you got to make sure you have enough cash, yeah. So that's basically what this losing streak diagram does and is, and you can see visually the probability of these losing trades. Right, so the most important bit is this, okay? So because we've touched on the maximal drawdown of being no more than, let's say, 20% in this example, what we would then look to do is take that 20% and split it into baskets of risk. So if you're going to trade 4 strategies, it might be a 30-minute, a 15-minute, a 1 hour, or whatever you want to do, that's your choice. Let's say you choose 4. We would then be allocating 5% to each of them strategies to stay within your 20% that you set. Where this goes to the next level is we are planning for those losing runs that are probable or possible to keep you within them 5% baskets of risk. So let me show you what I mean. So let's take gold 15-minute strategy. Let's say the win rate on that's 22%. Let's say we've allocated a 5% basket to our risk because we're running one of 4 and we've set it at the max at 20. Hopefully you're with me. This basically then tells you here what our aggressive, cautious and sensible risk levels look like based around what's very likely, unlikely or probable losing streak. So on that win rate of 22%, it is very unlikely that we could see a losing streak of 27%. What's more likely or more probable is a losing streak of 17. It's very likely we'll see a 14. You can see all these numbers on here. So this one here is where you might enter your own. You might go, okay, well 27 is very unlikely, 17 is more probable. I'm going to plan for a 20 losing streak to give me the confidence that I don't really need to worry because that's something that I'm planning for. So what that does is it tells us that our percentage risk per trade should be 0.25%. This is also a great simulation for FTMO, by the way, because bear in mind that we've got a 10% maximal drawdown to hit and 5% per day. So it's unlikely that obviously you're going to see a consecutive losing run in a day because you wouldn't have that amount of trade outcomes, but definitely using this tool to use the data you have and planning the 10% within the 3 or 4 strategies is also going to be useful. So on a 22% win rate strategy, we're saying that we would risk 0.25% per trade. Okay. Now, if we had a win rate, let's say of 60%, the opposite occurs. So what we've got is probable, unlikely, and very likely. Very likely losing run of, well, let me do the coin analogy. Let's put 50% in, yeah? A very likely losing run of 5, an unlikely but possible maybe losing run of 10, and a probable of 6. Well, we might go, tell you what, we'll go with 6 on that. We can risk 0.83% per trade on that strategy, okay? So when you see our back tests and they're all done at 1% risk per trade, we have to test something. 1% is a sensible starting amount to look at. If you then do this, you would then adjust that 1% risk per trade strategy to 0.83 and you'd adjust gold back to 0.25 or whatever it was. Hopefully you get the point with this. What I'm desperately trying to get through here is plan for probability. If you don't want to feel overwhelmed, stressed, if you want detachment, if you want consistency, this is the granular detail that you need to get to. This will enable you to go about your day and not worry that you've got big running losses or a big losing run or anything else. You are planning for the fact that losing runs will happen. Whether you like it or not, they will. You're planning it within your risk management. Yeah? So we're going to finish our optimization on our testing, and I'll simulate then on another quick video that if I chose that, and that, and that, just as a random thing, these would be then the win rates, the risk per trade, and then what that projected equity curve would look like over time. So get yourself into this spreadsheet, understand it, learn. If you don't put the work in, nothing's going to change. If you don't take new action, nothing's going to change. You're just going to keep making the same mistakes that you have done up until this point. But if you genuinely want to take this seriously, if you genuinely want this longer term, consistent monthly gains that you tell me about on the survey, if you want to stop feeling overwhelmed, if you're running 4 strategies, right, and you've planned for the maximal or likely losing streak on every single one of them strategies, you're not going to be stressed, I don't think. Nowhere near the level of overwhelm or stress that you've probably felt in the past. This is something that I've gone through with the one-to-one traders that I've been coaching over a period of time, and it's transformed how they trade. Yeah, they are detached, they're bored, they're finding other things to do with their time, they're not checking their phone, and they're seeing consistency. Hey, look, not every month's going to be profitable, not every week, but you've got to stick it out. You've got to accept that those losing runs are there, but so are the winning runs. Yeah, but you've got to have discipline in your execution, belief, confidence, and stick it out. I'll just show you this on the whiteboard quickly so you can see a different visual representation of what I mean. Thanks for watching.